has been on a wild ride lately, a so-called safe haven asset, and yes, it's giving us all a few head-stopping moments. Are these pullbacks a buying opportunity for the bulls or a trap? Don't worry, let's break it down in just 3 minutes. Looking at the daily chart, gold started last week strong, climbing as high as around $42–45, making it feel like a new high was just around the corner. But the rally was short-lived. On Thursday, market sentiment suddenly shifted and prices pulled back sharply. Yesterday, gold even dipped below the $4,000 mark intraday, though it managed to close above it in the end. If the bears keep pressing, the first line of defense is the psychological $4,000 level. If that fails, the next support zone could be around $3,920 to $3,900. On the flip side, if the bulls regroup and push gold back above $4,100, last week's high near $42–45 could become the next target before testing a new record. While there are plenty of fundamental factors that can influence gold, for example, the market has priced the chance of a Fed rate cut in December down to roughly 40%, which is a headwind for a non-yielding asset like gold. But concerns over some tech companies' sky-high valuations and heavy debt are making some traders question their financial health and liquidity, which in turn has given gold's safe haven appeal a short-term boost. Long-term drivers like central bank buying are also seen as providing a floor for prices. I mean, on the surface, these arguments make sense, but actually the picture isn't so clear-cut. In fact, gold has been moving quite independently lately. Its 20-day rolling correlation with 3-month silver futures, a proxy for rate expectations, is only negative 0.03. In other words, the market's biggest question, whether the Fed will cut rate in December, has almost no impact on gold prices. Gold's correlation with the dollar, US equities, and treasuries is also quite low. This tells us that recent price swings are driven more by short-term flows and trading momentum than by any macro fundamentals. Actually, it's a good reminder that market sentiment matters more than ever right now. So this actually simplifies the key question. Where might gold go next? The short-term swings are mostly driven by one thing: whether the Fed cuts rates in December. And the single most important factor for that decision is the upcoming jobs report. Before we get the October and November numbers, we'll see the September report this Thursday. The data is already a bit old, but unless the labor market surprises to the upside, say more than 70,000 new jobs added or employment falling to 4.2% or even 4.1%, it should still support a December rate cut, which could give gold a modest lift. So, what's your take on gold from here? Do you think the jobs report will give the bulls a push? Drop your thoughts in the comments. I'd love to hear them.